I just started recording,
Okay.
so let's push forward and thank everybody for joining us, particularly thanks to Yanka. And Yanka, I want to introduce you just a little bit because now you're assistant professor of finance at Fordham University's Gabelli School of Business. I know you're focusing on empirical asset pricing. And I pulled this from your website. It says, quote, my research is about the differences in industry profits and returns and why certain industries offer higher returns. I also focus on machine learning algorithms and their applications to return predictability. So I got to know Yanka when he was studying for his PhD here at UC San Diego. We were sentenced to a couple capstone classes together. I think we got either hazardous duty pay or maybe even combat pay for those deployments. But a
Hmm.
little bit more about him. Great guy. He earned his BA from Penn State University. I think I'm a bigger Penn State football fan than him, but it's close. And MA from Johns Hopkins, as I mentioned, PhD here at UC San Diego. Yanka describes himself as an avid golfer, wine enthusiast, husband, and dog dad. So today we're going to walk through his Brandis Prize winning research, which is on industry concentration, sticky profits, and return dynamics. So with that, Yanka, I will turn the floor over to you, my friend.
Thank you, Bob. Let me share my screen. Yes. And then we can start. Okay. Let me make this even bigger, full screen. Mhm. 1 second. I apologize. 1 second. Let me make this. Here we go.
Yanka, I'm not going to yell at you for technology issues.
I mean, you will be I've been doing this a while, so it's kind of funny that I can't do it right now. But anyway,
Yeah,
okay.
well, perfect.
Wonderful. Okay. So, as Bob mentioned, my paper is actually about industry concentration, um, sticky profits, and that's going to be a very important component to industry concentration's relationship to the returns. Because what I mean by sticky profits is actually sticky expected profit growth. It's not just the level of profits, it's also how expectations of profit growth impacts returns. Okay. So what we've seen in the what we're seeing overall is that concentration is rising across the board. So if we look at since 2000, we've been seeing this rise in concentration, not just for business equipment, which includes firms like Apple and Microsoft, and even AMD or NVIDIA. It also is impacting retail, right? So like T-shirts and other stuff like that, right? Now, this is an interesting turning point, the year 2000, because even though I don't show it here on this graph, we've been seeing concentration actually decreasing from 1970s to late 1990s. So 2000 marks a really important point for us because that is when this trend of downward or less concentration is marked with now a rising concentration. Now, obviously, we're in the finance, and like Bob mentioned, I do empirical asset pricing. So my question is, okay, so what are the implications for this? Okay, so what does it mean for us as investors? Well, as it turns out, um, since the 2000s, what we see is that there is this huge a gap in returns for across industries. And so in this graph, what I show is like take your industries, sort them by concentration, and build concentrated industry portfolios versus competitive industry portfolios. So the blue line here marks the returns or cumulative returns of the most concentrated industry returns, and the orange line shows the most competitive industry returns. So there's definitely some gap. Um, and on average, more concentrated industries earn about 3.5% a year more than competitive industries. Okay, so now we have this link between industry concentration and returns, and the question becomes, why should that be the case? Right? So that's really where my research lives, or where this paper lives. Why should we expect these highly concentrated industries to have higher returns? So what I find is that expected profit growth is much more persistent in concentrated industries. So take, for example, autos, or take Apple, or take the software or hardware industries. It turns out that their expected profit growth is much, much more persistent than, say, your retail industry. What that has an impact on, or that has two effects. One is higher persistence makes these profits more sensitive to economic cycles, so booms and busts in the economy, okay? Which in turn also makes them more sensitive to cash flow news. Cash flow news, it's I, I like to think it's not an academic term, but it probably is an academic term. Cash flow news is about shocks that come into aggregate dividend growth, aggregate profit growth, and actually stuff that's related to cash flows to firms. Okay. But this has two implications, right? So higher sensitivity of profits to economic cycles and a higher cash flow news contribution in returns have two implications, direct implications. One is higher risk premium, right? And the other one is higher conditional volatility during economic downturns. So as you can see, the story that I'm telling is not really about alpha generation, but it's more about risk compensation. Right. So one of the tenets in finance, right, as we know, is higher risk, higher reward. So that's because you need to be compensated for the higher risk that you are actually exposed to. So that's where I'm going with this story. So the take-home message is firms in concentrated industries offer higher risk premium, but face higher volatility during economic downturns. Right. Okay. So let me show a couple of graphs that is really building the story. We see a 50% correlation between expected profit growth persistence and HHI. Now, HHI is the Herfindahl-Hirschman index. It's not only used in academia, but also used in antitrust laws, right? So they look at HHI, and that's a measure of how concentrated that industry is. So we see this, upward sloping curve. There's a 50% correlation between highly concentrated industries and how much of their profit growth is persistent, or how persistent they are. Now, this concentration, I guess the next question we should ask is more about, okay, so why should we expect these profit growth to be more sticky or more persistent? Well, there is a product rigidity or fluidity measure that was developed in 2010, I believe. I'm not 100% sure, so please don't quote me on that. But the main idea is these researchers go and look at the products that these firms are putting out there in the market, and they're measuring how much competition there is across this, or how much competition there is across this product, right? Or in this product. Well, it turns out that as we go towards more concentrated industries, there's less and less and less competition for these products. So one example that I give is Apple versus Samsung, right? So if you're an Apple user, you typically have the iPhone. Then if you need to change your phone, then you go with an iPhone. On top of that, there is this ecosystem that Apple brings you, right? So you want to stick with an Apple. So these kind of creates less and less competition across what Apple produces. Now, on the other side, we have these easily substitutable goods like t-shirts. I don't have a preference on where my t-shirt is being made or how it's being made. Obviously, I'm not talking about cruel conditions, but I'm talking more about branding, right? So if I need a t-shirt, I go buy one. And if there is a terrible shock, or if there's a economic bust, then what I do is maybe I don't go to, I don't know, Hugo Boss. I go to Walmart to get my T-shirt, right? So it's very easily substitutable. There's a lot of competition in that. So that's why we kind of why the economic reason as to why there's higher expected profit in these highly concentrated industries, because they corner the market and they grab more and more and more of these profits for themselves. Now, in my opening slides, I mentioned that these highly concentrated industries also have profit growth that is cyclically sensitive. So what I show in this table is a super simple regression that basically says I am going to take first I'm going to sort these industries into concentration quintiles. Then I'm going to look at their profit growth, and I'm going to regress that on a recession indicator, right? And the idea and what I'm hoping to get out of this is actually understand how much of your profit growth gets affected when there is an economic bust, right? There's a recession. So as you can see, for example, for a highly competitive industry, so Q1 quintile, the profit growth drop is about 2%. However, when we go to the most concentrated industries, we see that this drop is about 4%. So there's a doubling of profit loss, if you will, right? Profit growth loss. Not only that, for Q1 and Q3 quintiles, these estimates are not statistically significant. However, for the most concentrated industries, the negative 4 percentage point is actually highly significant, right? Okay. So I'm hoping I don't want to, take this to super technical terms, but I really need to get this point across of why should concentrated industries be compensated, right? So the story is actually if there's higher persistence in profit growth, then the present value coefficient in front of cash flow shocks is going to be higher. And if that's the case, then based on our research, we can see that these highly concentrated industries who are highly cyclically dependent or cyclically sensitive needs to compensate us investors for being cyclically sensitive. And that's why we see this risk premium going up. Now, in the bottom, in the note, I tried to give some type of intuition as to why we should expect this case. So suppose there's a negative shock to discount rates. Take your super simple present value relationship, right? You have the cash flow on top and you have the discount rates in the bottom. If there's a negative shock to discount rates, that actually improves your future investment opportunities, right? So if the interest rates are low, then you can go invest and make more money, hopefully in the future. However, if there's a negative shock to your cash flows, not only your today's present value is impacted, but all your future present values, the present value of your cash flows are also impacted. That's why if an industry or if a firm is highly sensitive to cash flow shocks or cash flow news, we as investors need to be compensated. That's what this fancy equation really shows. Right? It's actually, in my opinion, pretty intuitive. But I'm more than happy to talk about this if you have questions. So that's the main driver, or this equation is the main equation that I think really showcases why we should see higher risk premium for concentrated industries. Now, I promised in the beginning of the talk that I will also mention something about volatility. So now here I'm actually looking at the volatility of the returns for these industries, and I'm decomposing this volatility into actually two main components. One is the red one, which is the cash flow shock, so volatility due to cash flows. The black one is volatility due to discount rate shocks, and the green one is the covariance between the two, so they could be correlated. As we can see, for example, autos, which is really highly concentrated, right? So you have your Ford, your GM, and all of those guys. We see that at each point there, for each recessions, the cash flow component of volatility just skyrockets. It kind of and then it disappears. However, for retail, right? So if we look at this top right corner, for retail, most of this volatility is driven by discount rate checks. And as I was mentioning earlier, if you're highly dependent on discount rates, you should probably not worry too much about it because your future investment opportunities are still there, or even probably better, right? So anyway, and so what I then do is say, okay, so I've hopefully convinced you in the short amount of time that concentrated industries profits are cyclically sensitive, which makes their exposure to cash flow shocks much more salient. And then I said that not only that, but their volatility is also driven mostly by cash flow shocks. So here, what I want to show is like a summary statistic on looking at, okay, again, across different industry concentration bins, how much of the volatility is impacted by recession. So on the left side of this table, I'm regressing volatility on just a industry or just a recession dummy. And there, what I'm showing is that, for the more competitive industries, volatility maybe goes up by 0.14, but for the most competitive industries, it's doubled. And not only that, it's also highly significant. Now, that needs to have a direct impact on the Sharpe ratio, right? Because now we actually have an idea of what the returns are going to be and what the volatility is going to be. So we can actually directly measure or compute the Sharpe ratios for these industries. So I do the same exercise. I take the Sharpe ratios for the most competitive industry and the most concentrated industry, and I regress that on a recession dummy. And there, what we can see is again that the Sharpe ratio for a competitive industry goes by about 0.02 during a recession, but for a more concentrated industry, it actually drops down by 0.09. So that impact is actually more than doubled, and it's statistically significant. Now, Bob, I think at this point, I know you said that you wanted like 5-10 minutes of hard-hitting points, and then you wanted to open this up to more questions and conversation.
Yeah.
I think this is a pretty good stopping point. Otherwise, I'm more than happy to talk about the model and all that stuff.
Yeah, that's a great overview, Yanka. Thank you. I've got some questions, but I'll put mine on hold for a little bit and ask if anybody else has questions for Yanka.
Well, I need to go back to school and look at all the factors that in this HHI index that would be helpful for me to understand some of the points that Yanka has made. So that's my chore, not anybody else's.
Well, but it's actually pretty intuitive index. You basically take all your every firm's sales, you square them, you sum them. And the idea is the higher the number, the more concentrated it is, which basically tells you that more of the sales within that industry comes from one or two firms relative to many, many, many firms.
Does the dispersion of the cohort for these various metrics?
For an HHI, I don't think there is a dispersion metric because what they do is they define an industry, however, whatever the antitrust people want to do it. And they say, okay, in this industry, I have many X amount of firms. Then what I'm going to do is I'm just going to look at their dollar sales and square that number and sum it up. So I'm not sure if there is a dispersion number for a given year, but we can definitely do that for across years.
Okay.
Yeah.
All right. Somebody else has to have another more intelligent question.
I've got questions, Bill. I don't know that they're more intelligent, but any others? All right, I'll jump in with some of mine because Yanka, I went back and reread your paper last night, and where I struggle is with this notion of persistent profitability. So when I think of companies in concentrated industries, I'm thinking of like an Amazon. And I'm thinking almost like a monopolistic grip within that industry. So profits, not surprisingly, are going to be more persistent. They're the dominant company in that industry. And then if I was paying attention, you're saying that profit growth persistence is also cyclically sensitive. And there's a part of me that thinks they might be immune from economic, macroeconomic fluctuations. But then in some of the charts that you shared here, which I did not see in the paper, that might be specific to industry as well. So the autos are going to be maybe a little more susceptible to cash flow shocks. And when you say cash flow shocks, I think of company specific shocks more so than a macroeconomic shock. But maybe the two are kind of intertwined. So am I making any sense here?
Yes, I think yes, that makes sense. So in the paper, I actually, you said that you've skimmed through the paper last night. One additional contribution that I make here is that not only I have aggregate cash flows, right, which basically means that how much did the economy grow? Think about it that way. How much did the economy grow in terms of profits? And then there's a specific industry component to that because each industry can grow at a different pace, right?
Mm-hmm.
Now, one thing that I would like to clarify in your question is I am not focusing just on the profit levels, but also on how much that profit grows. So profit growth.
Okay.
So what I find is that we as investors, or from the data we're gathering, that profit growth persistence is higher, not just profit itself, but profit growth persistence is higher. And the reason for that is as Amazon grows larger, they capture more and more share of that market. And they do this more persistently. So we expect their profit growth, not just their levels, but their growth to be also persistent.
Yeah.
Now, the point of this, or where this heterogeneity across industries are coming, is their levels of concentration. Just like you mentioned, Amazon is a pretty big player. Autos and Ford and GM, all those guys are pretty big players. So we expect that those, if you're a Ford loyal customer, again, you're going to go back to Ford and buy another Ford and stuff like that. Or if you're like GMs, that's where you're going to go and buy Chevy stuff, right? So that kind of is there. Now, that's why I mentioned earlier, Apple versus Samsung versus T-shirts, right? So now I want you to think about if a shock comes, there's a recession. During a recession, say you need a new car. If a recession hits, would you buy a new car?
Less likely.
Right. I wouldn't buy a new car. Right. If a recession hits, would I buy myself another, expensive computer? Probably not.
Yeah.
But when a recession comes, you still buy yourself T-shirts. You still have to buy yourself, a shirt because you have to work, right?
Right.
Maybe you don't go buy the Tom Ford shirt and you go to, I don't know, Joseph A. Banks, right? But you still buy a shirt.
Right. Right.
Which means that at the industry level, not at the firm level, at the industry level, this recession is going to have a higher impact on industries that have cornered the market and are super expensive, right? Relative to stuff like T-shirts, where we can actually substitute these goods and be like, instead of buying a $50 T-shirt, I'll buy myself a $10 T-shirt, but I'm still going to buy a T-shirt.
Okay, got it. So, and that ties back to that rigidity of product or service within that industry. Okay.
Exactly.
Okay, thank you. And that maybe ties in, because as you were talking, I was also reading about expected returns. So, you've got this, and I can think about this in two ways. So if my expected profitability is high and the delta for that is high, then part of me might look at it and say, oh, my returns should be better than companies who can't deliver on that. And then the other part of me looks at it and says, well, you've already had decent returns. So your prior returns may be really good, but your future returns are going to be lower because there is going to be some reversion to mean. But then I also think in some of these monopolistic companies that they're not mean reverting. And I think of Amazon's and the Nvidia's, like they've been able to grow profits consistently for years. We had a webinar last week. Bill Nygren from Oakmark was talking about that. And apparently he's done the work. He said, you go back and look at Nvidia, what they were expected to earn in 2019, in 2025, they've actually outpaced the analysts' expectations. So the expected profit levels they're delivering are better than what we thought X number of years ago. So again, part of me would say, okay, from this point going forward, the returns have to be lower. And I've been saying that for years, and that just hasn't been the case.
Well, I think so. And correct me if I'm wrong. Maybe I misunderstood the question, but my initial reaction to your comment is you expect some type of reversal to happen,
Yes.
right?
Yes.
However, if Amazon, just think about in simple first finance class terms, right? Present value. Think about it in just present value terms. If I think that Amazon's profit is going to be higher and higher and higher and higher going forward, why should there be a reversal? Right? If profit growth, again, expected profit growth, if it's supposed to go up and up and up and up, just by pure valuation, you would think that it should have higher returns or it should have higher price. Now, there are nuances that maybe we can talk about later. If there are nuances, what happens during a recession, how should we revise our expectations going forward and all that stuff. But that is super, super nuanced in that sense.
Yeah. And then along that line, so again, forgive me, I just finished Jeremy Grantham's new book, The Making of a Perma Bear. And he talks about this at the end. And throughout his career, 40, 50 years, he had made so much money on profit margin reversion. And he would say when profit margins for this company get fat, competition is going to increase. It's just like oil, right? Oil prices are high, it attracts tons of competition. Eventually, it's going to bring oil prices down. And then he was writing the book, finishing it first quarter of last year. And he says, or he writes, I haven't seen that. I haven't seen that working. That profit margin reversion that was such a mainstay for guiding where to allocate capital has not been working recently. So
allow me to make a point there. You have an underlying assumption. If the profit margin is huge, you literally said that competition would come and cut that margin out.
Yeah. But
if the firm is actually becoming cornering more and more of the market, then you don't expect that to go down.
Yeah. Yeah. And in that case, and this is one of the other questions I had, kind of related, but a little off. Like, do you expect government intervention then? And every so often you'll see something in the news. Oh, they're going to crack down. They're going to break up Google, or they're going to break up Amazon. They're going to break this up. Do you expect that to happen? I know this is kind of off topic, and I'm asking to make a prediction about politics, which is impossible. But any thoughts on that?
So my thoughts on concentration and potentially policy is it's actually really hard to make a decision on this. And allow me to elaborate on that. There are certain industries that are inherently more concentrated. Think about rubble. Think about mining, right? Those guys require a lot of capital upfront to do this. Now, suppose the margins are huge. Can you and I create a company tomorrow and go and buy all these tractors and heavy machinery and all of that stuff to go into that, industry? My initial reaction is no. I mean, I like you very much, but if you wanted to build a construction company, my reaction would be, I don't think so. Thank you.
Yeah. Yeah.
Now, so that's the, barriers to entry argument, right? Another argument is, suppose you have Apple, right? It's becoming more and more, cornering more and more of the market. So it's also collecting those rents or those margins, which are great, good for them. What do? They go and invest in R&D, they develop a new product, right? And all that stuff. Could you go in and generate this new technology for them? I don't know. But if we decided to break that up, then what we're basically saying to Apple is you should stop innovating. Don't put money in R&D, right? Because the idea is this: if the technology is better, then consumers are going to go to that technology, right? Well, Apple, I think, is a very niche case in this in here, because Apple doesn't just produce, computers and iPhones and all of that stuff. It also has a software component. Then you get really comfortable with that ecosystem, like you were saying, we're all slaves to Outlook, right? I like to be able to go on my iPad and have the same thing to open up on my Mac. Then that goes into my iPhone. I feel
Yes.
connected. I live in that
Yes.
ecosystem,
Yes.
right? So there is that component for sure.
Yeah. Rhonda, question?
Hi, thanks very much, Yanka. The quick follow-up question on that. Obviously, the tech and the chip companies, in particular, the NVIDIAs, are the elephant in the room right now. And sort of this idea, going back to Bob's point of we haven't seen the mean reversion, but as longtime value investors would anticipate that an extremely large margin over time will bring in competition naturally. And whether government does anything or not won't change whether China's DeepSeek next generation can change that. And so just your thoughts there. And the second point, the question just on the AI disruption to industries, looking at something perhaps right now like software, where you've seen an enormous correction not that would not have been predicted by previous cash flow sustainability.
Those are really, really good points. So the first point I think was um, NVIDIA and those guys, right? Okay. Um, NVIDIA, I think, and related to value itself. Well, if the analysts that are covering NVIDIA, right, are saying, well, they're going to grow and grow and grow. Now I'm not sure really what the valuation should be. I'm not going to make a statement about the fundamental value of NVIDIA, but I want to make a statement about the expectation of the market regarding NVIDIA. If we expect Nvidia to grow and grow and grow, we already expect the prices to reflect all of that expectation, right? That's at least how we think about prices. To see a reversal, I think you mentioned a slight correction that happened, right? And that correction happened because Nvidia was not able to meet investor or analyst expectations. So there's a slight correction there. But I believe that actually really touches on my research and into the core of it, honestly. Because my research basically says, sure, you can be concentrated. Yes, we expect you to grow more. But when a shock comes, especially to your cash flows, your returns are going to adjust more than competitive industries. So that's exactly the play that we're seeing here, right? We expected NVIDIA to meet certain numbers. They didn't. It's a cash flow shock. Returns are going to react immediately in a very, very abrupt or shocking way. Now, what do I think about software and LLMs and all of that? I am not an expert in AI. I don't know how these companies are, investing in each other and all the capex that they're doing. But my gut feeling is that entry to that market is already very difficult because you need to have GPU technologies to feed these LLMs. You need to have certain skill sets that are highly skilled people to come in and train these models and develop these models. So if we take that itself, the LLM and AI as an industry itself, there sure is going to be some type of competition. But I also think that, if that competition is not really doing well, they're going to be kicked out or be acquired. That would be my knee-jerk reaction. Right? I hope that answers your questions.
Thank you.
Thank you.
Good stuff, Yanka. Thank you. Any other questions?
have you done any work at all of looking at kind of as we look at past innovations that go through the decades, through the generations, like kind of a CapEx spend along with this industry concentration? Meaning, kind of in our point of view, sometimes when you see excess CapEx spend or high amounts of CapEx spend, that tends not to set up good returns for shareholders. Is there anything within in this type of lens?
I don't think this paper speaks directly to that. It's more about again cornering the market and becoming more and more ingrained into this. Now, I really do not know how CapEx. I mean, at least quantitatively, I do not know how CapEx would impact profit growth persistence in this case. So.
Yeah, I've come on Rob's point. Like, what's the disruption? When does that happen? And how does that affect asset pricing? Yeah. These past correlations change as you have a shock.
So do you mean in the persistence itself? When shock comes in, what happens to persistence?
Well, maybe your new innovation that you had that led to some of that concentration. Maybe, it's hard to see when that stops.
Well, so in this setting that I've been talking about, persistence is fixed in the sense that we expect we expect persistence to be stable. That's an assumption, right? We could change that and see how that would work, but it's playing a key role, and I think it's really it probably is going to resonate with you. When a shock comes to a persistent system, that shock persists a bit longer, and that shock's impact is slightly larger for longer. Now, does it mean that if a shock comes to NVIDIA today, that NVIDIA is not going to recover? I don't think that's the case. I think that what we are going to see is exactly what we've seen. Shock comes, there is a huge drop in returns. If it's a negative shock, drop in returns, and then we expect NVIDIA to recover from that. That's my point of view on this. Now, I could be wrong, but because I am not I don't know everything.
That's where the debate is. That's where the fun is.
You'll have your crystal ball at Fordham.
Right. That's what they do. You open the door, they give you a crystal ball, and that's it.
So, Yanki, what will your role be at Mario Gabelli's shop?
As like what I do on a day-to-day, or
where are they hiring you from an expertise standpoint?
From an expertise standpoint, it's I think a combination of machine learning and empirical asset pricing. So again, pretty much what I do is I just do research. I focus on these papers, try to develop new ideas along the ML and empirical asset pricing side. I also teach a couple classes. It's a pretty good life. I can't say it's bad.
So, but did I misunderstand? Are you working for his firm or just no? I'm sorry.
I'm a professor now. I don't work directly with the Gabelli fund.
Yeah, I thought they were dropping in your expertise to their process. So
they might. We don't know. I don't know.
I hope he's doing okay. I saw him present, Bill, at that Value Invest conference last week, and
Mario Gabelli.
Yeah, he was hospitalized that afternoon.
Must have missed that.
So, Yanki, early in your slide deck, you showed the outperformance in these concentrated industries. So here we go. So if I'm looking at that, do you think that's going to continue? Because I kind of get the sense that it is, or this is kind of an aggregate of concentrated industries versus more competitive industries.
That's exactly what it is.
You know,
At each point in time, I look at the distribution of concentration, and I build a portfolio based on more concentrated industries. So that does not mean so it could be that if the autos industries falls off on the cutoff, then they could drop out of this portfolio. But this is just and I think it did a good job. It's just to get your attention early.
oh yeah.
But so going back to this, I don't want the message to be concentrated industries earn alpha, right? It's not really alpha. It's a risk story.
Mhm.
Concentrated industries are risky, and because they're risky, as investors need to be compensated. That's the main story.
Yeah.
Now, in your email, you asked about what are these strategies, or how should we think about this, and as a value investing shop. Well, so I will punt the answer to that to Campbell. John Campbell, I believe in one of our earlier meetings, I've shared a paper on the booms and busts of value. And the main argument, and actually this potentially ugly looking equation, is used there as well. And what they argue is value itself has a higher loading or higher sensitivity to cash flow shocks. That's why investors need to be compensated for that. Now, what happens, and his argument is after the COVID and recent low interest rate environments and all of that, their argument is the value premium, as he calls, the value premium still lives within industry. So if you wanted to buy the more, the higher value in book to market terms firms and short the more expensive firms, there's still going to be that premium. But again, that premium itself, again, is not an alpha, is actually compensation for risk, right? And throughout these, well, now I'm getting all the reminders to join the.
Starting in 15.
Yeah, on your presentation that's going to start. It's already 45 minutes old. Thank me for that.
Stuff happens, technology. And their main argument is that this is, again, you're compensated for risk, and you're specifically compensated for cash flow risk. And their argument has been that throughout these past years, there's been shocks to cash flows, aggregate cash flows, which impacted value investors more than say growth investors.
Yeah, and I'm embarrassed, thinking back to when you think about cash flows, there's like 3, 4, 5 elements to that, right? The consistency, the timing, the magnitude, et cetera, et cetera. So it kind of makes sense. And one of the other ones, you remind me showing these models, one of the other ones that you shared was on recessions. And
right.
If I hear that right, then it's during a recession, then the cash flow news becomes more critical for concentrated industries. So if there's a recession, then it's not just the recession that's going to impact the company, it's specific cash flows. Is that correct?
So if we're going to, you want to run? No, actually, it started at 11. Started at 11? Yes.
So
that was Professor Chatterjee from Fordham asking if the meeting starts at noon. So I think, going back to your question, it's not just about the level of cash flows, right? It's about the risk in the cash flows. So if there is a higher sensitivity of this industry to cash flow shocks, then the risk around its cash flow is also going to be higher. And that's what we measure in in this graph right here. Right. The cash flow shock comes in. What we expect is that because this highly concentrated industry is more sensitive to cash flow shocks, we expect that returns are going to be reacting more relative to competitive industries. And then I talked about volatility of that return, right? And in this graph, what I'm showing is that the volatility of the returns can be decomposed into cash flow shock versus discount rate shocks.
Yeah.
And because the concentrated industry is more sensitive to cash flow shocks, you expect the cash flow component of volatility to blow up. And that's what we see.
Got it. Got it. Okay. Thank you.
Of course.
Good stuff.
You asked in your, so I would feel bad if I don't answer your questions.
Yes.
So there is another point that you've made about, so what would this mean for valuation? Well, I think this model or my paper actually supports higher valuation for these concentrated industries. And the reason why they have higher valuation is because they're expected to have higher and higher cash flows over time. But there's a caveat. The present value equation itself only tells you what it should be in expectation. So when a shock comes, right, that valuation might drop pretty harshly.
Yep.
And I think that's exactly what Rhonda was saying. You know, what happened to NVIDIA? There's something happened. There was an adjustment, right? Shock comes in. The adjustment, the magnitude of the adjustment itself is going to be much, much larger in a concentrated industry relative to a competitive industry.
Yeah. Yeah. That makes sense. It's just, as you kind of alluded to earlier, it may be harder for some of these companies to experience those shocks given the level of CapEx, technological innovation that you're going to have to introduce to dethrone, if you were, some of these companies. So, as we often say, it works right up until it doesn't, but it can work for a really long time.
Yes. Yeah.
Which is, it reminds me, we tend to dance around all these related issues. Cap weighted indexing is supporting a lot of these companies, and that's, we hit that on the webinar last week. So that just seems to be what's happening for the foreseeable future. Now, does that mean there's no other opportunities in the market? Of course not, but there's still a lot of money that's chasing after those companies.
I mean, so think about it from an investor's point of view, like your typical retail investor, your 401k investor. If these companies are growing and they're getting higher and giving me higher and higher returns, why shouldn't I chase that?
Right. Right.
And if we really take a step back, what happens is actually capital allocation, right? Because now these guys have higher valuation, they have more cash on hand, or they get more cash, and then our hope is that they're going to invest this to something more innovative, right?
Yeah.
And hopefully you get some of that back.
Yeah, and it's I don't know that the analogy I'll make here works 100%, but the 401k money going into cap weighted indexes seems to be a concentrated industry. And I would liken it to be very hard to change that. Your point about it, and I'm in the same boat, right? I got my Apple phone, I got my watch here. I'm not going to switch. So for somebody to say, oh, I'm going to switch my 401k allocation out of what's been working for 10 or 15 years, we'll see. It certainly could happen, but it's a little like changing banks or changing cell phone companies. It's a pain.
Yeah, that's true. I mean, Apple really ingrains you in it, right? Because what was their slogan? It just works, right? You expect that to continue.
Yes. Mhm. Yes. All right. I know we're covering a lot of ground here. Any other questions? I feel like I'm dominating the conversation. Suresh, I know you joined us late. Alan, thank you so much for jumping in. Maybe you can grill Yanka.
Mhm.
Give him something really hard.
No, he's doing great, yeah. So I didn't want to intervene since I know the paper very well. It was great to see it presented, yeah. You know, we had a whole day of presentations at Baruch yesterday. So busy guy. Mm.
That was fun.
Yeah,
That was fun.
that's right.
Well, and Alan, you can take a lot of credit for grooming not only Yanka, but a lot of other PhD candidates. I know you're working with Fabrizio right now and others. So thanks for all the work you're doing here. It's
Yeah, no, we have been blessed to have a wonderful pipeline of excellent PhD students, and they're like Yankee, they're placing very well. It's not easy to get an academic job these days. Job markets for academics are becoming increasingly segmented and hard to predict. Even what type of job is it in economics? Is it finance? What type of school, etc. So no, Yankee did exceptionally well in the market, and for good reason. You can see this was the paper he presented last year.
yeah, but it's consistent with, and I think it's why he won the Brandis Prize for at the time for master's or PhD candidates because it bridges academic theory and practical application. And Alan, you've done a ton of work along the same vein. I've seen you present on looking at Google for home prices and what does that tell you in the future. So to me, that if it's got a foot in both camps, where it's got that academic rigor and it's got some practical practitioner application, it's going to make it that much more interesting or relevant.
Yeah, no, and I think that what you'll see is that academic work in finance will become increasingly, industry relevant and focused. It's just part of this whole AI revolution where suddenly we can do things with data sets that also are used in industry, right? So it sort of bridges the gap, I think. So we'll see more and more of this type of research. And I think, this, I mean, my takeaway is that, well, concentration is both a blessing and a curse, right? And it's interesting, right? Because it goes both ways.
Yeah.
And, you may be concentrated, but if you're concentrated, there's a target on your back. There's a bullseye on your back. If you have I mean, how long do you think NVIDIA is going to reign supreme in this industry? I mean, they're signing all sorts of partnership deals on the financing side. They're super smart about it, right? So that they tie in customers within, investing billions and billions of dollars in their products. But of course, that's because they know that there's so much competition for their, in that industry, given the profit margins. So I think this fits in nicely with Yankee's story.
Yes. Yes, indeed. And a related topic, when you talked about data and getting the data, that to me is a very concentrated industry. And the price for data, it's just insane, to try and get some of this stuff that people have. I don't want to name names, but there's a few out there that really control the data in the industry, and it makes it tough to get.
Mhm. The one thing you might also want to look at, Yankee, in the future is spatial concentration, right? One of the reasons why Vulcan Industries that produces they crush rocks, right? But they have, I think, the highest, second highest cumulative return of any firm in the history of the US stock market. I mean, they've been around forever because it's so hard to get, licenses to operate mines and to distribute it and so forth. And same thing. So you can actually have spatial concentration locally. And then we're getting a lot of new data, and that would fit in nicely with your model, perhaps. And there's so many new data sets. I mean, that's an explosion where you can now see down to the transaction level at individual retail stores. And these data sets are costing hundreds of thousands of dollars, if not more, because they're used by hedge funds.
Yeah.
So yeah. So this is, I mean, how to even think of concentration, right? And sort of like monopoly rent, the protective moat, right? It's very interesting because it's changing all the time because of technology.
Mm.
That's very cool.
I'm this close to deviating into asking Alan to talk about the work that you're doing with Fabrizio. Speaking of
Aha. No,
your
it's crazy, right? I mean,
really
yeah.
specific, getting down to, I had lunch with him last week and he was talking about, looking at foot traffic or, is somebody buying if they're in downtown La Jolla or are they walking the dog? You know? And how do you distinguish between the two and what is that telling you?
It's the dwell time that gives it away, how long you're dwelling. Just don't ask your dog to stay for too long to pee, because that way we're thinking that you are shopping. If it takes more than 3 minutes. No, actually, I kid you not, that they actually register these things on your phone. So yeah, whenever you carry this, it's a snitch. It gives away what you're up to. They even infer if you're working from home. So if you go from your residency to an office, say, and you spend a lot of hours there, they know it's an office building, and then 2 days a week you don't do it, then they assign you to working at home those other 2 days. It's kind of crazy, right?
Wow. Wow. So the dog has its leash and we have our leash.
Yeah, on the apps. Yeah, that's right.
But remember that also now downtown La Jolla, recent statistic, over half of commercial spaces are no longer hard goods for retail, but services. You've tipped over.
Hmm.
Mm. So like what kind of services? Banks?
Real estate, yoga studio, Pilates,
Mm.
uh, dog
Hair,
walking, I'm sure,
Mm.
hair salons.
hair
I have
salons.
a lot of experience with that. Okay, Yanka, any closing comments? Anything that you want to share that we didn't touch on?
Um, I don't think, I hope I was able to answer your questions. I think there was a very nice conversation, which that's exactly what I hoped for. And if you have more questions about what I do and about this stuff specifically, please do send me an email. I'm more than happy to chat more about this stuff because obviously it's I find it interesting.
We'll definitely do that, and I plan to write up something about this conversation and kind of meld some of the comments that you made and others with the paper that you've done. And I might hit you up for a few of these charts that we can put in the piece and then post it to the Brandis Center website and then promote it. Would like to raise more visibility for you and your work.
Thank you. I would love that. Thank you so much.
So Bob,
Good luck to
maybe,
you.
yeah, thank you. Maybe Brandis should have a long short concentration portfolio that they could invest in. It's not a crazy idea, by the way, perhaps, right?
Well, Grant, Rhonda, you want to tackle that? Because when I worked there for 20 some years, I got all these kinds of questions. I would go to these conferences and we would present, and somebody would come to me and say, "Oh, so you work for a long only value shop, so you don't short anything?" Nope. And then they would say, "Does your car have brakes, Bob?" And I would say, "Yes." A little different thing. We're driving for the long term, but long, short. Grant, Rhonda, any thoughts on that? Want me to stop recording?
Yeah, no, you could actually record. I could never see it, right? Because you think about the structure that we've built. It's focused on the long, and it's a different capacity to find the shorts, right?
Right.
It'd take a lot more people to isolate that. So I think we're pretty set on focusing on what we have done on the longs.
What
Also,
about a long concentration portfolio? Is that something you have any interest in, or?
We've dabbled that throughout the years, but it's never been we actually had a foundation that had us operate a 10 stock portfolio for a number of years, but would how about this? I don't proactively talk to universities due to that strong preference, and that profile just hasn't been kind of what has been typically found within our portfolios to that extent.
Right.
Just to add on the short side, that I know intuitively a lot of people feel if everything we're doing is trying to come up with that long-term conservative valuation, that appraisal of a company intrinsic value, we'll call it, why don't you know? Why won't you short it also if you feel it's overvalued? And the key there is there's a time element. It's a completely different skill set because, of course, you have to borrow shares and it costs you when you're shorting as opposed to a long position. So that's why we will not be going into shorts, and it's different skill set.
Yeah, very much so.
I'd see a concentrated portfolio before a long short. How about that? If I'm playing my odds.
Yeah. Mm-hmm. No, fair enough. Yeah.
Okay. Hey, great questions. Thank you so much, everybody. Yanka, thank you. Thanks, everybody, for being on the call. And hey, we'll do this again Friday. We got another one coming up, but I think I'm going to go back to the presenters and see if they can present at 9 Pacific. You know, just trying to change the time for 50 people versus changing the time for 2. But with this one, you know, Yanka, I didn't remember that you had a flight to catch.
Oh,
So
that's new news. That's a new news. That's yeah.
Okay, well, we'll edit that out in the video and make sure that that was the reason that we moved this to 8. I'm kidding.
Right.
All right. Hey, Yanka, everybody, thank you. Thank you so much.
Thank you so much.
Thank
Okay.
you.
Bye-bye.
Bye.